Welcome to the Property Couch, where each week you get to listen to two of Australia's leading property experts as they share with you the insider's guide to property investing.
Jingle bell, jingle bell, jingle bell rock.
Well, there you go, folks. You're on the Property Couch, your insider's guide to property investing, and Ben is getting very much into the Christmas spirit here. I'm Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle channel, and he's Santa Claus, also known as Ben Kingsley, the chair of the Property Investment Professionals of Australia, and the 2014 and 2015 Property Investment Advisor of the Year, and of course the Christmas Carols DJ on the Property Couch. How are you, mate?
Ho, ho.
Mate, you getting into the spirit?
Merry Christmas.
Good to see.
Good to see you.
Done all your Christmas shopping?
What's that? Yeah.
Mate, you got one present to buy, and that's your wife's.
And guess what? I bought it and I took it into the spare room
Yeah.
and I put it on the bed and I said, don't go into that room. And she went in that room to clean it up because we had people coming over and she saw a gift.
Oh, wait. Is
Yeah,
that a premeditated plan not to wrap the present?
Pretty much.
Well, there you go, folks. Hopefully, I'm not sure a lot of you will be listening this side of Christmas or that side of Christmas, because some of you may be at the shops doing your last minute shopping, but I hope you've had a great lead up to Christmas. But we're going to talk today about a few things. Largely, I want to talk about a story, Ben, in the lead up to Christmas.
Mm-hmm.
I was
a good story.
I was dealing with a client who said to me, chose me as a buyer's agent.
Yep.
And made the decision that they didn't want to use our mortgage broker, which is fine.
Yep.
It's their prerogative.
Absolutely.
But,
But I have an existing mortgage broker that they're working with.
Well, interesting you say that, because he said, no, I met a guy down the road and I just want to give him a go.
Okay.
Just want to give him a go.
Give him a go.
And the challenge with just giving him a go is we now are
Nice guy.
six
Nice guy.
days late for settlement.
Mm.
Penalty interest is already over $600
Ouch.
that the client has to pay, and they're now in hindsight saying, I wish I had have listened to you about who I should have used as a mortgage broker. Now, the point in telling that story is I think there's probably some gold in that to unpack, because it's always the hindsight lesson that we learn our best lessons from.
Yep.
And looking back, he just thought that someone was going to facilitate a finance transaction. That's all he needed. But you can see now through this process that he was sadly mistaken.
Yeah, it's, we talk about investment savvy mortgage brokers, and there is a lot to being a mortgage broker that is all around property investing. And, we've talked about it before about, sort of playing 3 steps ahead in the game. So if you're going to build out a multi-million-dollar property portfolio or multiple properties, you're going to have to take on a lot of debt, okay? And when you do that, you're going to have to look at serviceability. And serviceability you're going to look at not just today and which lender you choose, because you might choose a lender that has a really sharp interest rate but really poor servicing. Now, what that means is once they do the servicing calculator, your borrowing power is based around that servicing calculator. So if they're conservative, it might mean that lender A allows you to borrow $500,000. Now that's okay for your first property because you're buying a $480,000 property, it passes the grade. But there's lender B, which has a slightly higher interest rate, but will let you borrow $650,000. So that gives you the opportunity, 18 months later or whatever, to potentially get that lender to actually do the next loan. Now, there's a lot of things going on, a lot of moving parts in the mortgage side. Firstly, that a lot of people talk about, splitting their lenders. So a bit like, I've talked about BHP, does a $500 million mine. They have a primary lender, lends them $300 million. They have a secondary lender, lends them $150 million, and then a third lender lends them $50 million. So that's sort of how they spread risk. And that's how the lenders spread risk too. But there's a thing called aggregation in the mortgage space, which means that the more money you borrow, the better the pricing you get. Okay, so lenders will look at your total lending, and make no mistake, the big lenders in town want to try and capture all of your business. All of your credit card, all your offset accounts, and hold you because you're a stickier client. You won't necessarily, move on. So in our business, we sort of think around $1 to $1.5 million with one lender, and then look at your second and third lenders as you build out that portfolio. So it's good to understand. And why is that? Because you might get a 1.2% discount off the standard variable rate, whereas if you're going lender by lender by lender by lender, ultimately that's going to cause some concern. So for those really sophisticated people out there, the first thing you want to be asking your savvy mortgage broker is, how does this lender service existing debt? Some lenders will service existing debt based on a set interest rate, so maybe 7%, and other lenders will service the existing debt based on whatever the current rate is, so let's call it, say, 4.5, and then put a 2% loading on it. And APRA's come down pretty hard. So prior to the changes that we saw mid this year, some lenders wouldn't even put a loading on it. So that obviously allowed borrowers to borrow more money, and that's what's slowing down the rapid activity in the investment market, which is probably a good thing from a sustainable industry point of view. But when you're looking at your own personal circumstance and you want to get ahead in the property space, that's an example, and we've got more to talk about.
Yeah, I think that's, I guess the lesson from listening to the last couple of minutes from you for the listener, and it's probably permeated throughout every podcast we've done, but ultimately buying an investment property is complex. And we've talked a couple of times about investment property being a game of lending, not a game of bricks and mortar.
Yep.
So I think that's probably the number one thing that I see that people confuse, is that they just want to facilitate a transaction with the bank, and it's just not true, because there's mortgage insurance, there's valuers, there's DSRs or debt to service ratios, there's LVRs, there's a whole range of things that you need to understand as a property investor when it comes to lending. And if you're mortgage broker, and full respect to any mortgage brokers who are listening here,
Yep, they're all qualified, they're all licensed.
It's like a tax accountant. They've got volumes and volumes of tax act that they've got to get their head around. So don't shoot them because they're not specialists in property, because they've got a lot to do.
Correct.
So, but if someone makes the time to specialise in being a lender for property investors, essentially that's the person you want to talk to if you want to build a portfolio. If you want to pay off your principal place of residence and do one transaction on your PPR, anyone can facilitate a transaction.
Yep.
If you even want to just buy one investment property, probably anyone can do it. But if you're thinking about buying multiple properties and building a portfolio, you really need to think thoroughly about the decision that you make as to who you should engage. So I thought today we could really talk about what you should look for in your professional advisors, probably specifically with mortgage brokers. But for me, the number one thing, if a client says to me, what's the best interest rate you can give me? I quickly make a determination that this could go 50-50 whether or not we want to deal with it. Because if they're price sensitive and totally focused on interest rate, because sometimes, as you said, sometimes you'll recommend that an investor actually pays a higher rate but get a better structure, which means they save more interest over the life of the portfolio. So as a mortgage broker, someone who's been in the trenches, mate, what would you, if someone's saying to you, I need a mortgage broker, what's 2 or 3 things you can think of off the top of your head that they should have on their shopping list when they're talking to someone?
Yeah, I mean, obviously it is, what sort of experience do they have in dealing with property portfolios? So when you've got multiple properties, you've got multiple loans, you've got uncross securitized lending. Again, coming back to that interest rate question, it's a really good one. Pre-GFC, what happened was we had really cheap money overseas, really, really cheap money. So the likes of the Rams, the Aussies, the Wizards of this world could go and buy their money really cheap overseas, good margin in it, and they could undercut the big banks. And so a lot of people took up, a lot of those sort of second tier or non-bank lenders. And when the GFC hit and effectively the whole financial system froze, all of a sudden that money wasn't available. And so what we saw there is the cost of funding for those particular brokers and mortgage aggregators just went through the roof. And so that doesn't sound a big problem for them, but a big problem for when you've been dealing with, say, 200, 300 clients, and they've all got certain types of lending with a certain type of lender, and all of a sudden those lenders just carte blanche put their rates up, 2%. So you think, wow, I got this nice sharp interest rate at the start, but now I'm absolutely getting smashed on the cost of that. And then they did things like ratchet up their discharge fees and their break costs. Now we've seen that it was so bad that the government changed the rules on break costs so people could move lenders quicker. So again, it comes back to, I think the first point is, I think when people sort of say, well, what's the interest rate? I think it's naivety. I think it's like, well, that's all I know. And then probably on, now with the internet and a little bit more knowledge and a few more, YouTube videos, programs like this, allow people to understand what's available. So offset accounts, splits, lines of credits, interest-only loans, sort of those types of structure. Yeah. So you hear me talk about strategy and structure. That's the main role of the mortgage broker. They've got to understand the strategy. So, and then they've got to get the structuring right to try and accommodate that. Now, all things being equal, there will be changes in the market that even the mortgage brokers can't predict, such as APRA. So you might have set it up nicely and it's ready to go, but APRA come in and say, right, banks, you have to do this. We control you. And so that still might stop that next play, but you're giving your borrower and your client every chance to make that next move. Because as I said, it's not so much about even the saving on offsets and all that. There's hundreds of dollars in that, but there's tens of thousands and hundreds of thousands of dollars in controlling a bigger property value base than worrying about, the money you're paying.
What about glass ceilings, where people they've got their internet banking with one bank, they feel comfortable, so they want to stay with that person. They've got a manager they've been using for years, and they don't want to change. I always think that you want to take some advice around that, because you don't want to hit the ceiling on risk profile for one particular bank when across the board you wouldn't be necessarily breaking any risk profiles if you spread the lending. Not too dissimilar to what you said about the BHP sort of splitting up their lending.
Yeah. It's a good question. I mean, at the end of the day, and let's talk about direct lenders. I mean, if you're, got a fairly good income, you might have a personal banker ring you up. And in some cases, the big banks have call centres who are full of personal bankers, and they call themselves those personal. So a lot of people think, oh, this is really great. I've got my personal banker. I can deal direct. Now, the positives of dealing directly with a bank, and let's be honest, there is definitely a positive. And that is that some of those lenders have what we call DLA, Direct Lending Authority, and they can lend up to $1 million based on what they see in front of them. A mortgage broker has to present a really strong case to the bank or to the lender to get that outcome. So it's like they don't trust us. Even though we're acting as an agent, we've got to be able to prove it. And that's a fair call, because, fraud, mischievous behaviour can occur in any industry. And when money's involved, and commissions are involved, that's sort of what happens. So in some cases, if you have a really long-standing relationship and that that direct lender has been able to get you the funding every time, that's great. The only thing I make sure they don't cross-securitise you, because they're famous for doing that, the banks.
By default.
By default. So that's the one thing you want to look at. But then flip to the other side. I mean, mortgage broking started in the early 90s in Australia, okay? And now, on the conference I was just on, we're up to around 55% market share, and everyone thinks that we'll go as high as potentially 65, possibly even 70% market share. Now, why is that? Why is it that a broker is going to basically outplay the banks? Well, there's a lot of reasons for that. One is flexibility, convenience, and
choice.
Spread of, you go to a bank and you've got 6 lenders to choose from. You go to a broker and you've got 30 plus lenders, all with 6 or 7 options inside each of those lenders. So I think, if I was to define the reason you go there is basically that ability to work the market in the best outcome for the client. So ultimately you're working on behalf of the client, whereas the banker is working on behalf of their bank operations. So that's where the proposition for the customer is so strong in the mortgage space.
I remember I've got a mate who works with one of the 4 pillars, and he used to always tell us about the entanglement training that they used to have on Monday mornings. And it was feeding on from what you said before, was their job was to get the transaction account, to get some lending, to get some insurance, so they like an octopus entangled the client. And then if they get the nirvana of cross-securitizing their assets, that means that client's very, very unlikely to change, because they just go, well, gee, I like my internet banking, I know how to log on, plus all this stuff, it's just too hard for me to change. But and that's okay if your plan is to just buy your own home and pay it off. But if you want to be serious about investing, you wouldn't do that. But the point is that the client at the top of the show, when I talked about the fact that he's now in penalty interest territory, burnt a lot of anxiety as well, frustrated. He's a busy professional and outsourced this to make sure it wasn't part of his front of mind that he had to deal with. And then towards the end, the vendor said, yep, we'll accept that, you need to settle later, but we're going to charge you that penalty interest. And if they look at that over the term of the loan, and they weren't a price sensitive client, but, I guess at the end, if the penalty interest versus the price sensitivities that someone has when they come and do these interest rate shopping, we've got to see the big picture here. And to me, it's a bit like when you choose a property manager based on, are they going to give me 5%, are they going to give me 7%? You're taking your eye off the prize.
Yeah, look, you've just sparked something that's important in our business, and that was that you can have really strong technical people, so real great knowledge of the types of product knowledge that are out there. And let's face it, 30 lenders, over 1,000 loan products. If I was to quiz our brokers on their skill sets, they're not going to know all of that, but they can drill into it and get right down to the nitty gritty if they need to. But their level of product knowledge across the board is really strong. So, strategy, structure. But if they're poor time managers and they don't process the loan properly, and so, this makes a good point that...
Can I say I think this is poor time management for the cause of this? Can I say?
Correct. Yeah. And look, if they're a busy broker as well, so if they don't have, like in our business, as you well know, we have support staff who process the loan through, because the broker is the technical, competent one that needs to set the structures up. We have an internal credit assessor, and then we also have a processing person. Now, the reason for that is no mistakes. In terms of late settlements, I think, this year we'll probably have had 2, and some of those, some were overseas. It was an interstate transaction. There were, one just went off the rails and nothing we could do to bring it back on. So it still happens even in the best processes. But so customer service. So have a look at their customer service, their satisfaction, the testimonials of those brokers in terms of, they might know their content really great, but once they've got you, you've signed up, and now you're in that corridor with them, and you can't get off those tracks. Then you could get caught out just basically through poor processing.
To our listeners, it's a very huge time of anxiety when you're trying to get the finance sorted and meeting deadlines. And so one of the questions I would ask your mortgage broker that you're talking to is, how well do they or the people that are involved with their business understand credit and the policy of the bank from credit? So by that I mean, people are at the other end of these banks. It's not just some big ivory tower, and someone's going to pick up your file. And so they develop an understanding on which particular brokers are most likely to package up an application that is got everything that they need versus someone who puts in a lazy application and they think, that'll go to the bottom of the pile. So what I'm saying here is you need to ask them, how do you ensure that my application becomes a top of the pile one once it reaches the bank, rather than one of those ones that they roll their eyes and go, that one's going to miss this, that one's going to miss that, and therefore you don't meet these deadlines in a timely manner.
Yeah, it's a great point, because at the moment there's been record numbers of sales happening in Sydney and Melbourne. Most banks are at sometimes 5-day turnarounds. So if you put an application in and that application doesn't make doesn't have a complete packet, is what we call it. So once the packet's put together and submitted to the lender, if they're still chasing, wait a minute, one of those pay slips is outside the criteria, or, I still need to see a bank statement, all of a sudden that comes back as conditionally approved subject to further information. Now that's 5 days lost. Then you're chasing your client for another 2 pieces of information. That's another 2 days, and then you're putting that in, and then it's going to be picked up in another 5 days. So it's really important. If you've got a 30-day settlement, all of a sudden time is of the essence, because usually, even though you might have signed the contract, it's probably 2 days before the contract gets to us, and it's then probably 24 hours before the lending application's put together and it's signed by the client. So all of a sudden we're at day 14, day 15. We've got to get formal approval. We've got to get the mortgage docs back. We've got to get those to the client to vet and review, sign off. We've got to get them back to the bank for them to vet and sign off, and then book their settlement. So it's a huge process.
Oh, absolutely. And even for me, it's part of our process internally here. It's just not negotiable that our team has to get a copy of the signed contract to the financier the day that the property is signed off. Yeah. Or if it's not the day, it has to be
7 o'clock that night.
Even if it is, it goes through. It has to be 2 minutes after we receive it, because we know that what you just said is the most frustrating thing when someone says it's going to take them 5 days to pick up a file. I'm thinking, I've got 10 business days to
You've
get
got
this
a subject to finance
going on here. So those 5 days are critical. So there we go. Hopefully that's helped you. Our producer Ives has put a Q&A under the nose from Andrew Lowe, finance related. It's very much along the lines of what we're just chatting. Hi guys, loving the podcast. You've talked in past episodes.
Yeah, look, I think the main thing also that you put in there, Andrew, is you wanted to talk about why do all mortgage brokers just pick on the big four. And so I want to probably spend a second on that as well.
Yeah, so I'll just quickly read it out.
Yeah,
So you've
sure.
talked in the past episodes about what to look for when choosing to engage a property manager for your property investment property. Could you discuss how you'd go about selecting a mortgage broker? So hopefully that's given some tips. I've utilised the services of mortgage brokers in the past, and I found that many of them are purely transactional, and that's the key.
Yeah.
You don't necessarily want a relationship, not a transaction, and only use the big four lenders.
Yeah, so the story about the big four is post GFC, we saw that the cost of funding exploded, and it was very difficult for the smaller lenders to compete with the £800 gorillas. So, and in fact, a lot of the second tier banks were bought by the £800 gorillas to make them £1,000 gorillas. So from that point of view, and we do use the big four quite a bit in our business, and I want to probably let you know, Andrew, why that's the case, because at the end of the day, their features and their product offering is quite advanced. Their flexibility, their offsets are multiple in some cases, and they do have leading products and they have leading pricing. Now, there will always be an internet lender or someone who will undercut on price. So in our view, and it's not just to say that it's absolutely set, it's not a lock, we're big four, but in most cases, if we're going to build out a portfolio, we're going to pick a lender that's going to be that foundation lender. And then the second and third tier lender might be second and third tier lending from a sort of secondary bank or a third party lender. So I think that the message is, that's not to say it's a lock. I mean, you might go and speak to a broker and they can argue a really strong point for why you might use, say, an ING or a Liberty or a La Trobe or one of these, a Heritage Bank or ME Bank, whatever it may be. They might have a reason for that. But our reasons have always been around the fact that after seeing some of our clients get burnt through cost of funding and so forth, that we just thought it's important. And I know we make them, these banks bigger by maybe putting some more business with them. But the reality is it may actually be in your best interest because it could be still saving you a dollar. We're not interested in getting high interest rates for you to get best flexibility. Interest rate and cost of funds are going to be important, but ultimately, it's a combination of all those moving parts that make our call. And if say a Suncorp comes up with a cracking deal, and every now and then they have got some cracking deals, trust me, we'll be taking the client to wherever the best interest for our client is.
Who's APRA oversee? Is it just the big four?
No, it's basically Australian Prudential Lending Authority. So anyone who has what they call deposit-taking institution. So if they're a deposit-taking institution, they're under the APRA. So they're under a banking license.
All right.
Okay, so if you're in some cases, some of them aren't deposit-taking institutions. So, but what that means is that they won't necessarily have offsets and they won't have all these other sort of flexible and product features that are going to be relevant to the client.
Well, this is important why you need to choose wisely then, because you need a specialist investment savvy broker to know that. They need to have that primary lender and they need to know when it's a good time to use secondary lenders and
Correct.
And also, one of our team was talking about how instead of doing 5-year fixed, they're doing 3-year fixed because that was helping them with serviceability. So these little tweaks that come from knowing multiple banks and setting up portfolios for investors for a living rather than doing it as 5-10%.
Correct, and one thing that's amazing about the lending industry is it's an evergreen product. And by that I mean, now that there's, the break costs are now pretty much void, you've now got the opportunity to say after between 3 and 5 years, you should be looking at your numbers and saying, is this still a good product? Were these pair of shoes that they were the best at the time, but is there something else that's on sale or is there something else coming there? So again, your great broker should be referring to you not in the first 2 years or 1 year, because that's a bit of churning. To be honest with you, once all the inconvenience and all that, they're probably doing it for their own dollar gain, as opposed to probably after between 3 and 5 years, you should be starting to saying, maybe it's time for a change. In fact, I'm doing it right now, and I've, over the 20 years I've been investing, I've been with 6 banks, and now I'm sort of having another look. So, and I've been with one bank, the last bank for probably the last 4 years, and I'm now just getting some valuations from a couple of other banks because for me the valuation is the most important thing, not the lending. And so I had a cracking valuation on one of my properties. I couldn't believe it. That's another story for another
Lock and
day.
load.
It was like lock that one in, mate. Yeah. So and that's going to determine. I'll definitely take my business to that lender based on the valuation.
You mentioned churning, which is where the broker runs their own agenda because they can get a commission up front rather than what's in the best interest of the lender, of the borrower.
Yep.
Can you think of any, just in the interest of balance, can you think of any other negatives that you've seen from using a broker? Obviously inexperience, the ability to churn, probably not understanding building portfolios. Anything else?
Yeah, definitely. I mean, the way in which they set up their LMI, Lenders Mortgage Insurance, it's pretty complex, but Lenders Mortgage Insurance is on a rating scale. So it rates from 80%, so an 80% loan to value ratio up to 95, and then it rates on different loan balances. So less than 300,000, 300 to 500, 500 to 750, 750 to a mil. Those unsophisticated or naive or junior brokers will structure that where the client could potentially be paying more LMI than they need to because they've put a high LMI on the new purchase but not taken the other loan up. So an example would be, instead of say doing an 80% on one loan and then doing a 95 on the new loan, they should have taken the other one up to an 84 and then do an 88 on the other. And then all of a sudden the combined tally of those two LMIs might save $1,000 as an example. So there's plenty of, again, and this is
There's
probably
a Christmas
the value.
present there, folks.
There's probably
right there.
And that's why you need to be explained that. So when we do, rather than doing 90% loan to value ratios, which is what a standard sort of broker would think, I'll just do a 90% on that one, we try and get it down to 88. And that might shave off 0.04%, which is about $900 depending on the value of the loan. So it's like, guys, we'll just show you, if you can find me $2,000, I can save you $900 in a fixed cost that's, yeah, sure, it's deductible, tax deductible over 5 years, but that's $900 in your pocket.
Mate, look after the pennies and the pounds will take care of themselves.
Pretty much.
Very good. All right, well, folks, that's it for us in terms of before Christmas.
Yeah.
So it's been a good year, Ben. I mean, if we think back to the fact that we started this podcast back in February, we started out by saying we fix bad property investment advice. Probably a little bit bold at the time, but
I think we had some runs on the board. I mean, the honest truth is that there's people who are getting stung all the time in this space, and that's why we put this together.
Well, our agenda all along was to give back to an industry that's been good to us personally. So we hope that our listeners have enjoyed that. Hopefully there's been a few tips and tricks along the way. One of the things we thought we might do this holiday season, Ben, is because we've got the book out, we thought we'd see if we get our listeners to pass that on to the next generation. So over the holiday season, if they could grab a copy of the book and just take a photo with their loved one, the young junior, pretending to read the book or hopefully reading the book, and just posting that on Facebook.
If they are, we'll probably employ them if they're,
well, we'll just set them up.
less than 10 and they can read.
It's like the soccer scouts, isn't it? You know how they go to junior soccer and they
like
sign them up.
Have
So we'll do that. We'll go and sign them up nice and early. So if they post that to social media with the hashtag Armchair Guide to Investing, we'll see that. And we'll collect that and we'll put some of those up on our website. And at some stage in the new year, Ben, we might have a prize for the person with the most creative idea around passing on that information to the next generation. So that'll be a bit of fun. What's your plans over the Christmas break?
We're heading up to the mighty Murray River. My folks have a property up at Yarrawonga, and so we'll be spending a bit of time up there and drowning a worm and sitting around a campfire, and a bit hot this time of the year. I was speaking to Dad on the drive this morning actually, and he says it's 40 yesterday, 42 tomorrow, and 42 today, and going to be hot over the weekend. So I'm like, seriously, that's just a bit too hot. It's December.
Yes.
So that's the sort of weather we expect for February.
But this is Melbourne, mate. As soon as it's Christmas Day tomorrow, probably rain in the morning. It'll probably be hot in the afternoon. It'll just be it's not Perth-like, that's for sure.
True. And what about yourself?
Mate, I think you've just swollen the numbers for Yarrawonga just quietly. You've probably sent all of our listeners up there to try and have a chat.
We're not going to be buying property at Yarrawonga, and it's
no, they want to see you.
No. Well, I'll be out on a farm somewhere, so they won't probably be able to find me. So we've got a property outside of outside of town.
For me, I'm heading to the country as well. My wife's father's brother's got a farm. So we're going to there for Christmas lunch, and then we'll spend some time with the kids over the break, spending some time swimming in the pool. So as you scramble for your phone, any sort of late news?
No. I'm just sort of.
I know exactly what you're up to. I know exactly.
The sing out of the.
What you're up to. Come on, mate. Come on.
You ready?
So there we go.
Jingle bell, jingle bell.
So there you go, folks. We certainly, for those of you who celebrate Christmas, we hope that you have a great day tomorrow. For those of you that you don't, we hope you enjoy the holiday season. And Ben, I think there's only one logical way to sign off today.
There is,
and that's Santa.
Where's he from?
Well, we talked about this. It could only be Iceland, couldn't it?
We think
that's
so.
That's the closest to the North Pole. So, mate, until we'll be on next week, but we certainly will be part of our summer series. So, mate, until next week, let's sign off on the North Pole.
Icelandic, and oh my God, how do you even start with this stuff? No, I'm going to have to try another one. There's three there. You have a go. You might have a go at that one.
Icelandic. So, Vertu Blasur.
Oh, no, that one's all right. But what about that one there?
Yeah, but, mate, go. That's see you later.
Vlos. Slumunt.
It doesn't matter. Santa won't be listening because he's only got one property in a poor location, so he'll be working year after year after year because he doesn't get the location right. He doesn't understand that location does 80% of the heavy lifting. Buying property on the North Pole isn't going to do it for your retirement. So
the easier one was, yes, you're right. Vertu blessure.
There you go, folks. In French, Icelandic, Vertu blessure. Have a great Christmas, and we will see you next week. Bye for now.
Bye.
That's pretty good.